So Kevin, we're now going to talk about annuities. And I know,
Annuities.
I think this is confusing for some people, or maybe it's just me,
Yeah.
but what it really means and why you would do it or why you might not do it.
Yeah. The annuities is the A word of investment planning. It's the used car, so to speak.
That's
the cliche.
It gets a little scary to think I'm giving
does.
you all this money and what's happening, but
Yeah.
maybe explain what they are and what do you do and how do you help your clients?
So the first and foremost thing, you have to understand annuities is a tool. Okay, is a tool for retirement planning or investment planning. But any tool can be overused. Any tool can be too complex to use. So there's a whole bunch of things when it comes to an annuities. Annuity is an insurance contract. Okay, so the person, typically speaking, has to have some sort of life insurance designation with their investment. But there's three basic types of annuities. There's the variable annuity, which means that the investment you're putting money into this chassis, the shed, so to speak, and you can invest in mutual funds or money markets or whatever. But the risk is then on the owner, right? If I would put $100,000 into a variable annuity, the market drops, I should expect my variable annuity to drop, right?
Okay.
The shed that we talked about, that we put it in, protects the investment from taxes. Okay, so I can buy and sell inside of an annuity and not pay capital gains.
Oh,
okay, so
all right.
that's a benefit. Okay, so that's the variable. Then you have a fixed annuity. All right, and a fixed annuity is, hey, like you go to the bank and they say, hey, you give us, $50,000. We have a 3-year, 3% annuity. You get 3%. Okay, it's fixed. The risk is on the bank at that point, not on you, because they're guaranteeing you a 3% return on your money.
All right.
Okay. And then there's the fixed index annuity, which can be super, super, super complicated. But that's where a lot of advisors and clients get into trouble. Because it sounds like a lot of great things, and sometimes it's true, sometimes it's not.
Is this the one that supposedly doesn't go down when you reach?
Sure.
Yeah.
Sure.
I think I've heard of this.
Sure. So it's once again, you're investing money into an index, but you're not investing it directly into the index. So they're gonna give you a percentage of whatever this index does. The percentage is called the participation rate.
Okay.
So you might have something like you get a 60% participation rate. So if you invest in the S&P 500 and the S&P 500 does 20%, you get 12%. If the S&P 500 does negative 20%, you don't lose anything.
Okay.
So it's hey, it doesn't go down, right?
Okay.
So you don't get all the upside, but you get none of the downside.
Gotcha.
So that's where people start getting, well, why wouldn't you have all my money in here, right?
Well, why wouldn't you? Let's hear it.
because now you have the participation rate, which is 12, but then a lot of times you'll have caps on it, which might be 4%. So the best you can do is 4.
Oh, so
All
you can't. The sky's not the limit.
The sky is not technically the limit. Now, some of them are. Some of them do have the sky is the limit, but then to get a good return, you'll have to do because they'll have what else called a hurdle then. So you have the participation rates at 50, so it does 20, that's 10, but then they have a 4% hurdle, which means the first 4% goes back to the company, so you only make 6. So there's a lot of different moving pieces. Mm-hmm. There's a lot of you'll hear I get asked a lot of time, hey, this guy on Saturday morning talking about these annuities and I'm sure that person does a good business, but why do we hear so much about them? And it's because you typically don't need to have a securities license, like I have a Series 7 license. You don't need a Series 7 license to sell them. So a lot of banks are able to sell them. Insurance companies are able to sell them. You don't have to necessarily be a fiduciary to sell them. So, and at the end of the day, the advisor, it's a commission. Most of the time, it's a commissionable item. So, you bring the advisor your retirement, and it's $200,000. They make $12,000 for an hour's worth of work. Mm-hmm. All right. Mm-hmm. I'm not saying making money is bad. All right, but you got to make sure you're using it proportionately, right? Why should you buy an annuity? And the reason why you should buy an annuity sometimes is, and how I determine whether let's go back to that. How do I determine whether or not you need it? Is we'll go through that fact finder. And we'll kind of calculate what your Social Security is, if you have any pensions or anything like that. and what your spending habits are and what's your need. So you have, let's say, when you retire, you're going to need $4,000 a month in just your needs. That's housing, car, insurance, stuff like that. And let's say you have guaranteed income of $3,500. Well, we have a $500 gap, right? So let's take a look at, so $500 a month, $6,000 a year. What can guarantee me or guarantee you a $6,000 income stream for life, and hopefully with rising income, right? And that's the only thing out there, that's going to, with the word guarantee in it, is going to be an annuity. So we have to figure out what annuity fits that situation at that time, and that might be a portion, of your. If you retire with $800,000, that might be $150,000 worth of your $800,000. So then, when the market crashes, because the market crashes on average once every 5 years, right? It doesn't have. When you retire, it doesn't mean the crashes, the bear markets go away, but when it crashes, that your basic needs are met. All right, and so that allows clients then not to fear the bear, to make sure that they're able to take advantage of it. Because the markets go down, well, hey, let's move our money around and buy more of these assets that are quality assets that are down 20, 30%.
Yeah.
But when you don't have that, your basic needs met, and the market crashes, well, you are too scared to do anything. And so then you're frozen. And so in the 70s, whatever, it's like something like 60% of the people had pensions. Now it's like 17%.
Yeah, right.
So the annuities have taken over kind of that, hey, if you saved all your money, hey, let's put a part of it in. You put that money in and consider it. That's how I use them. Yeah. Because as a guaranteed income device, because you can put a rider on it, you guaranteed income for life, and that's how I use them. Other advisors who don't have who can't sell stocks, bonds, mutual funds, some of them use them for just regular investments. The only other time you would use them is, or only time I would use them, is if you're a high net worth client, you make a lot of income every year, and you maxed out your retirement plans, right? To your tax deferred stuff. So there are stripped down annuities that get rid of like the death benefits and stuff like that. And it's just the annuity shell. All it does is protect from taxes. So it's a low cost annuity. It doesn't have a lifetime income thing, but then you can invest large amounts of money into there, and then that can grow tax deferred. And 20 years from now, when you retire, and instead of making maybe $400,000 or $500,000 a year, you're making, your $100,000 a year. Well, then we can start taking money out of that and pay taxes on it at that time.
Again, there's so much to think about with this stuff, and it's obviously unique to whomever you're dealing with and whoever you're working for.
But just think portion control. A hammer is a great tool, right? But you can't build your retirement house with just one hammer. An annuity is a great tool, but you cannot build your retirement off of just annuities. And there's so many times I find people that get referred to me, and for whatever reason, their advisor put them in all annuities. And it's just, it's really hard to get out of once you
I was just going to ask, can they get out of that?
They can. There's ways, but sometimes it's painful. Sometimes it's not that painful. But it's better to come in and talk to me, and I'll tell you the good or bad news about it. But a lot of times it's more important just to know and what can be done and can't be done. And
again, if somebody who's watching just want to, just here's where I'm at and just talk to you. I mean, is that initial consultation is just they can stop in and chat with you?
So on our website, I'm sure we'll have because you guys are building our website.
Yeah, that's right. Yeah.
So we'll have a section to sign up for an appointment.
Okay.
You can call. Our number will be on there. But set up an appointment. Walk-ins typically, I'm too busy nowadays to.
I didn't mean just pop by, but I meant just here, make that appointment.
Make that appointment. Come on in.
Here's where I am. Here's what I'm thinking, and then you get a sense of.
Absolutely.
And if I come in and say I have everything in annuities, you can say, sorry.
No.
Or maybe not. I can help you.
We'll go. You try to make lemonade sometimes, right. And so, but most annuities will have that 10%. You can take 10% out every year. But the problem is that people have bought these annuities over time, and they've turned on the income stream. Once you turn on that income stream, annuities very rarely go up. Variables can, if they're invested properly, but you start taking out that income plus the cost of the annuity itself, it's like riding in a hot air balloon with a big guy. It's you don't go up as fast.
Yeah. Okay. I got
Right. So
pitch the guy over.
yeah. Right.
Thanks, Ken.
You're
Appreciate
welcome.
it.